Let us welcome them.
Hi, good afternoon, everyone. So I'm Kejun. So for today's session, we'll briefly go through 6 sectors overview, which mainly are construction, industrial, property, and also renewable. Then I have my colleagues who cover oil and gas, Sean, to take you through some of the oil and gas sector highlights, and also we'll also go through the tech sector with my tech analyst. Okay, so without further ado, we'll kickstart the presentation for today. Everyone can see my slide? Okay, yep. So let's jump right in. Okay, so for first, we'll go through the construction sector first, which we have an overweight rating on. So basically for the construction sector, what we need to focus on in the second half of 2024 is basically the government infrastructure projects and also the the data center investments that have been robust in first half of 2024. And then basically for infrastructure side of things, we expect the Malaysia infrastructure projects to roll out to be focused in some of the states such as Penang, Sabah, Sarawak, and also Johor. And then with our channel checks with some of the listed contractors, MRT3 is likely to defer until 2025 lah. And then in terms of the Penang side of things, Penang LRT just received the green light from the government in March or April this year. And then basically now they are in the finalization stage with MRT Corp and also the SRS Consortium, which is 60% owned by Gamuda. And then in terms of they're finalizing the alignment, everything, and also the project cost, and likely the project rollout would we expect it to come in second half of 2024, likely to be in possibly around September. And then some other infrastructure projects that we should look out in second half would also be the Penang International Airport, which have an estimated contract value of about 1.5 billion. I think some of the contractors have been called for pre-qualification. So yep, by second half, we should expect some more news flow in this side of things. And then the Pan-Borneo Highway Phase 1B, and also the Johor ART, which have a 8 billion estimated contract value. And then in terms of the data center investment side, things are expected to remain robust, driven by the huge committed investment of about 190 billion, which is compiled by our team. And then basically the beneficiary of the construction sectors, we see it as the contractors with infra and also data center track record should be the key beneficiary of these teams. And then in terms of picks, we like Gamuda and also Kerjaya Prospect. And then I'll briefly go through the Penang LRT overview. So as I mentioned just now, Penang LRT is likely to kickstart its first phase in second half of this year. And then basically we expect the construction works to be in the range of 7 to 8 billion, with the works expected to commence in second half of 2024. And then we expect the first segment to basically align in this way. Basically, the first segment will be in the island side, and then the second segment would basically link the island to the mainland to the mainland. And then basically we expect Gamuda to be the key beneficiary, as they are the project delivery partner under the consortium, which they 60% own. And then in terms of the sharing of the contract, I think market is expecting Gamuda to get about 4 to 5 billion contract based on their 60% ownership. And then some of the other potential beneficiaries which they might share out the contract to would include Suncon, IGM, and also MRCB. Okay, so yeah, basically we are overweight on the construction sector, as we anticipate our coverage to benefit from the rollout of the infra projects, the data center investments, and also some of the building contracts from the property side. And then we like Gamuda and Kerjaya Prospect, given their respective strong position in the subsectors of infra and also building construction. And then in terms of valuation, we see Kejaya is trading at below the sector mean. And then in terms of the construction peers, we also have a buy on AME Elite, which offers a unique exposure for investors to capture the influx of FDIs. And as you know, AME Elite, they basically focus in industrial property in some of the FDI hotspots such as Johor and also Singapore. But then in terms of the thematic play, we do see AME as more of a property play. But then based on the classification, they are classified under construction sector. So here they are in the construction peer comp. Okay. Moving forward, I'll briefly go through Gamuda. So basically, we like Gamuda for its regional exposure in both construction and property. Where they have been consistently getting infrastructure projects from not only from Malaysia, they are also actively involved in infrastructure jobs in Australia, Taiwan, and also Singapore. And then in terms of the data center side of things, Gamuda has also expressed their optimism in securing at least 2 data center projects every year, where they will basically utilize their IBS capabilities. And then to recap, they recently secured a 1.7 billion data center contract from a US MNC. And then we believe Gamuda's current valuation of 17 times is reasonable, as Gamuda is expected to benefit from the infrastructure and data center projects rollout. And then another stock that we like is also Kejaya Prospect. So basically, Kejaya, they are more of a high-rise building contractor, and they have been delivering very consistent profit margin of 10 to 13% versus industry average of 5 to 8% only. And then basically they have been securing quite very consistent high-rise construction jobs from some of the reputable clientele such as Gamuda and UM Sunrise. But then in the past year we expect the order book flows to be mainly driven by its related parties, which are mainly E&O and also Kejaya Prospect Property, where basically the contract from these two related parties could amount to about 1 billion every year from this year onwards. So that provides some sort of like assurance in terms of the order book sustainability. And then in terms of the more advanced side of things, they also have a joint venture with Samsung, where it opens up opportunities for them to venture into design and build contract for advanced production facilities. For example, one of the contract that they have in their book is the Texas Instrument factory in Malacca. And then now I'll move on to the industrial sector. And then basically for industrial sector, the coverage that we have is mainly some of the mechanical and engineering solution providers that is well positioned to benefit from the data center investments and also the FDI investment into specifically the semiconductor sectors driven by the end user clients. So briefly go through the data center landscape for Malaysia. So Malaysia has attracted over 76 billion in data center investments, mainly due to the favorable conditions such as the welcoming of government policies and also the availability of cheap land and power. And then basically with that, the average cost of all this MNC to set up data centers in Malaysia is estimated to be lower than other ASEAN countries such as Singapore and also Jakarta. So basically some of the major data center operators such as AirTrunk, YTL Power, GDS, and also Yellowwood have secured more than 1.5 gigawatt for their Johor-based data centers. And then our utility, our TMB also highlighted that another 5 DC facilities are expected to be established with combined demand of 2 gigawatt. And with all that, we kind of compiled the data center development pipeline that could be underway. And we see the data center development pipeline could be in the range of 3.8 to 4 gigawatt, with potential investments of 190 billion to be rolled out in the next 5 to 10 years. And then from our sector, the industrial sector, as I mentioned, our coverage is mainly on mechanical engineering solutions provider, namely Critical, with a target price of 133, and also HE Group with a target price of 90 cents. And then basically why we say that, the mechanical and engineering solution providers are well positioned to benefit from this trend is basically because of their end user, where they are, that the end users are mainly from the structural growth industries such as semicon, data center, solar, and all this. And then basically the increasing demand for all this MEP engineering will be driven by the growth of these end users, and also the FDI inflows, and also the increasing relocation of E&E manufacturing activities driven by the trade diversion, the China plus one theme. So with all that, the strong, we see all these MEP players as strong proxy of rising FDIs. Okay, this is what I mentioned about the compilation of the list of data center investments that are committed to come into Malaysia in the next 5 to 10 years. And basically we see there's potential of 190 billion of investment coming in the next 5 to 10 years. And then okay, one of the top pick is Critical. So basically Critical is well capitalized on the semiconductor sector recovery and also the DC investment opportunities. I think based on their current order book, about 15 to 20% of their order books are from the data center side. And then basically they are they're proxy in terms of the rise in AI demand, which will basically accelerate the DC expansion. And then with that, it also resulted in quite a good order book prospects for the group with a 1.2 billion tender book, which they have they're tendering for right now. And then I'll move on to another top pick that we have for this sector, HE Group. So HE basically stands as a strong beneficiary of the FDI as well, in terms of HE, their main exposure is actually in the semiconductor side, where basically 70 to 80% of their revenue are driven by their clients from the semiconductor side. And then apart from that, they are also actively trying to expand their footprint into the data center space through a partnership with Vertiv. Basically, they are US listed digital infrastructure provider. And then in terms of apart from that, they also have a healthy net cash position of 52 million, which provide them ample of headroom in terms of gearing, and also it allows them to explore opportunities, M&A opportunities to grow its business, to basically expand its capabilities within the MEP space. With that, we are forecasting a 3-year profit CAGR of 30% for the next 3 years. And then this is mainly driven by the robust contract pipeline, so margin expansions that we see from the operating leverage, as they could potentially engage into some M&A opportunities to expand their capabilities to bring in higher margin and also higher contract value. And then I'll move on to the property side. So Malaysia property market saw modest, that saw gradual improvement in 2023, with overall value that increased by 10% year on year. And then in terms of overhang, is also eased by about 7% year on year. And then in terms of the overhang easing, the Johor came in as one of the main contributors, where the overhang in Johor eased by about 19% year on year. This is driven by the favorable market sentiment, driven by the ongoing and potential infrastructure rollouts, including the Johor Singapore RTS, which is under construction, and then the potential of Johor ART or LRT, and also the HSR. And then apart from that, the industrial property side has also seen robust demand driven by the surge in FDIs. Again, with along with the theme of trade diversion, the global supply chain relocation, and then this has led to quite a lot of FDI into states such as Johor and also Penang. And then in terms of the Johor side of things, the industrial property demand is also expected to gain further momentum with the establishment of Johor Singapore Social Economic Zone, which I believe they signed the MOU in early this year, and then they're expecting the better clarity in terms of the structure in potentially around October or November, along with the budget 2025 announcement. And then we believe the incentive for this economic zone will mainly involve in this tax incentive and also some of the incentive that would ease the flow of movement of goods and also people between Johor and Singapore. And then with that, it would drive the vibrancy of the industrial activities in Johor, and also coupled with the influx of data center investment that has kind of led to an increase in land prices throughout Johor due to the surge in demand for this land. And then basically for the Johor team, we prefer industrial park and also affordable housing developers, namely AME, Elite, and also Legenda. Okay, some of the key charts in terms for the property market. So as I mentioned just now, the overall value improved gradually in 2023, and also the overhang kind of eased down slightly from 2022. And then I'll briefly go through AME Elite, which is one of our top buy, one of our sector buy for the property side, and they are one of the key industrial property players. So we like AME for their core focus in developing industrial parks, which offer fully integrated construction engineering for the clients to create their factories and then to build their factories. And then they stand as a prime beneficiary of the supply chain diversification, which have seen its industrial park at Johor garnering the interest of some of the prominent MNCs such as Colourcorn, Oliver Healthcare, and also Insulet to set up their factories in Johor. And then AME is also expanding their presence to Penang via JV to develop a high-tech industrial park at Seberang Perai. And then the industrial park is estimated to have a total GDP of 1 billion. And we see this as a strategic expansion for AME because it basically allows them to replicate their winning formula that they have at Johor, where they managed to get quite some interest from MNC, and then basically replicate this model to another FDI hotspot, which is Penang. And then in terms of valuation, we ascribe a 14 times construction PE in this construction segment, and also 20% NAV discount to its property side to derive our 215 target price. And then our target price implies a 14 times forward 2025 PE ratio. And then in terms of the affordable housing side of things, we like Legenda because their core focus in affordable housing, while they are able to consistently deliver high profit margin of 18 to 20% as compared to the industry average of 10 to 12%. And then in terms of Legenda, they stand to benefit from its ongoing multi-state expansion into Kedah and Johor. Legenda's land bank in Johor contribute about 35% of its remaining GDV. But then in terms of this year, they are planning to launch about 2 billion new launches. And out of the 2 billion, 50% come from the Johor side of things. So they should be riding onto the team of the Johor property market team. So with that, we ascribe a target price that is based on 30% discount to its property NAV in anticipation of the stronger sales momentum driven by its ongoing multi-state expansion into Johor, Kedah, and also Selangor. And then another sector that we have is renewable, which we have a overweight rating on as well. So basically for the renewable side, looking what we like is basically the solar EPCC players, as you can see the two charts down below there in terms of the Malaysia's renewable energy opportunities. You can clearly see that solar energy takes up a great portion of the in terms of the potential and also the projected long-term renewable energy capacity mix. So with that, we should look at some of the solar EPC contractor names such as SolarWest, where basically they will be guiding onto the theme of the government consistent rollout of all these renewable energy initiatives such as corporate green power program, which we usually refer to as CGPP, and also some of the other programs such as NEM 3.0, and also the upcoming large-scale solar 5, which is the 5th cycle, which have a potential, which have a quota of 2 gigawatt. And with all that, all this consistent rollout of RE programs, these should basically support the sector interest for all these solar EPC contractors, as basically each round of all these RE initiatives stand as a catalyst for them to replenish the order book. And then apart from that, the implementation of third-party access, this basically means that it allows the power producer to directly sign a tariff agreement with the off-taker. But this implementation of third-party access should be finalized by September, where we can see better clarity in terms of the structure, what kind of wheeling charge they have to pay to the TMB. And then aside from that, the introduction of renewable energy certificates trading could also encourage additional investments in RE assets and also spur further excitement for the sector. So basically, we once again reiterate that we see the beneficiary of this whole solar team to be mainly benefiting EPCC contractors such as SolarWest, which we have at the price of 2 ringgit. So SolarWest as a prime, we see SolarWest as a prime proxy of Malaysia's target to reach the RE generation capacity of 70% by 2050, outlined by the NETR roadmap that the government has released. So basically SolarWest has strong track record in basically constructing all these solar farms, and as a group guideline, the group has been able to consistently secure 30% of market share in the previous cycles of all the renewable energies initiatives that I've mentioned just now, the CGPP, LSS5, all this. And then in terms of the upcoming contract rollout as well, SolarWest is expected to basically secure up to 1 billion contracts from the CGPP program. And then with that, we are forecasting a 3-year profit CAGR of 52% in the next few years, driven by the order book pipeline and so its growing solar assets portfolio. Okay, with that, I'll pass on to my colleague Sean to take over for the oil and gas sector.
Okay, thanks, Gijin. Hi, good afternoon, everyone. My name is Sean, and I'll be going through the oil and gas sector. I'll briefly talk about the global outlook and then Malaysia's outlook, and followed by our top picks for the sector. Okay, so first, for the global market outlook, we are expecting global oil prices to remain high, driven by the ongoing supply cuts from OPEC Plus and strong oil demand. In June 2024, OPEC Plus agreed to extend production cuts of 3.7 million barrels per day for another year until end 2025. providing market confidence over concerns of oversupply in the market. Shortly after OPEC Plus announced the production cuts, Brent oil prices fell below $80 for the first time since February 2024. But Brent oil prices quickly recovered back to around $85 after a better than expected global oil demand. So overall, we think that the global oil price will continue to remain high, and Brent oil prices to trade within the range of 85 to 90 US dollars per barrel in 2024. This would be driven by the ongoing production cuts from OPEC Plus, robust oil demand, and SPR replenishment, the Strategic Petroleum Reserve. Next slide, please. Yep, okay. So back in July 2023, SPR levels dropped to 347 million barrels, which was the lowest level since August 1983. One of the major causes of this is because in 2022, President Biden decided to release 180 million barrels from the SPR to aid the market and lower oil prices. As of June 2024, the SPR level stood at 371 million barrels, which is about 25 days of consumption. This is well below the IEA's recommended level of 90 days of consumption. So the DOE aims to replenish SPR levels to be at or above the levels before the big sell-off, which is about 560 million barrels. In May 2024, the DOE announced its plans to purchase up to 3.3 million barrels in October 2024. They also announced that they will continue to target buying crude oil to replenish SPR levels at about 79 US dollars per barrel or lower. So we believe there will be a strong support here for oil prices. Okay, next slide. Kijun, next slide, please. Okay. Okay, so now bringing it back to the Malaysia's outlook. The oil and gas industry here is quite heavily influenced by the capital expenditure of Petronas. So Petronas has a planned capex of about 300 billion over the next 5 years, which implies an average of 60 billion per year from 2024 to 2028. This as compared to the previous 5 years, the average capex was about 40 billion per year. So based on the Petronas activity outlook for 2024 to 2026, the biggest beneficiary segments would be the HUC, MCM, and the demand for offshore support vessels. HUC stands for the hookup and commissioning, and MCM stands for maintenance, construction, and modification. So HUC and MCM man hours are projected to increase by about 90% and 13% respectively in 2024, while offshore vessel demands is also expected to increase by about 18% year on year. Other beneficiary segments also include well plug and abandonment works, which Petronas is guiding 38 wells to be decommissioned in 2024, and then followed by an average of 50 wells annually for 2025 and 2026. The demand for jackup rigs and also the hydraulic workover units is also looking strong, with Petronas guiding an increase from 12 units to 13 units in 2024 for the jackup rigs, and 6 units to 8 units for the hydraulic workover units. The number of plant turnaround works is also expected to increase from 6 turnarounds in 2023 to 14 in 2024. So overall, we think that the oil and gas sector is looking very, very positive, particularly in the offshore segment, and we have an overweight stance on the sector. We recommend positioning in companies that stands to benefit from the Petronas activity outlook. And with that, our top picks for the sector is actually Dayang and Usma. Next slide, please. Okay, so starting with Dayang. Dayang is an offshore oil and gas company that provides topside maintenance, which is the HUC and MCM works. and then marine chartering services, which is the offshore support vessels. So we like Dayang for its position as a market leader in the HUC and MCM segment, and is set to benefit from the activity levels as guided by Petronas activity outlook. It has a strong order book of 1.7 billion, providing earnings visibility until end of 2026. We are forecasting a 3-year net profit CAGR of 20%, driven by increased work orders and also upward revision in work rates due to the demand for these services. Strong demand for these services. Dayang will also be participating in the in the tenders for the highly anticipated new Pan Malaysia HUC and MCM contracts, which are expected to have much higher service rates. The results are expected to be announced by end of this year, and then work should commence by early 2025. So there are about 18 total of 18 packages up for grabs in this tender, and we believe Dayang stands a very good chance to win a portion of the tenders of the packages. So we have a buy rating for Dayang with a target price of 3.78 ringgit, based on a 16 times P multiple, which is in line with its 5-year historical mean. Next slide, please. Okay, so next up is USMA. USMA is an integrated energy and technology company that provides innovative and cost-effective solutions across the exploration, development, and production value chain. Its main activities involves integrated well production and subsurface solutions. They also recently have been expanding into the renewable energy sector. They recently completed their 50 megawatt LSS4 project. So USMA has a strong order book of 2.8 billion, providing earnings visibility until FY26 and FY27. USMA also stands to benefit from the strong outlook for the well plug and abandonment works, and also the demand for hydraulic workover units, which USMA owns 7 units. So we are forecasting a 3-year net profit CAGR of 26%. The company actually has been steadily building a strong recurring income base with its 2 water injection facilities project. Each contract is about 300 to 400 million, and also the recently completed LSS4 project. USMA will also be participating in the upcoming LSS5 tenders as both asset owners and also the EPCC contractors. We have a buy rating for USMA with a target price of 2 ringgit based on a 12 times PE multiple. We like USMA for its competitive edge as an innovative solution provider and a key beneficiary of the Petronas activity outlook. So that concludes my section. I will pass over to Lucas for his presentation on the technology sector.
Thanks, Sean. Good afternoon, everyone. I'm Lucas Sim, the analyst for the tech sector, and I'd like to share everyone regarding our findings and our view of the tech sector. So, after going through a slowdown last year, we still see a sector recovery to take place in second half of 2024. Over the past 6 months, the local tech sector has benefited from the global market sentiment on the strong interest in generative AI and as well as AI-capable servers. And so far in the first quarter of this year, our findings show that the global semiconductor sales have recovered 15% year-on-year thanks to the American and also the Asia-Pacific regions. And we expect this momentum to continue towards the second half, which is aligned with ours and market intelligence such as the World Semiconductor Statistics, WSTS, SEMI, SIA, and etc., as they all forecast year-on-year recovery between 10 to 20% from the 8% contraction last year. We see the tech sector experiencing a growing demand for new and advanced technologies such as AI as well as smaller nanometer chips. Hence, this will drive the demand for the memory segment as higher bandwidth memory is required to run and support the processing capabilities of these AI technologies. And this segment is forecasted to grow 40% year on year this year, according to WSTS. And other segments are also poised to be in an uptrend, with US and APAC regions continue to lead the growth. Some recent updates that we have found, as reported by SEMI, in the first quarter this year, the sales for the electronics and integrated circuits, or short form ICs, has shown improvement. And these sales are projected to continue its momentum for the second quarter, anticipating about 5% and 21% year on year for these electronic and IC sales respectively. While CapEx is expected to see a slight rebound in the second quarter, while fab utilization rates further to soften. Next slide, please. So just like I've mentioned in the previous slide, many market intelligence, such as WSTS, SIA, and IDC, they both maintain their forecast of 13% and 20% growth respectively, as the global PC and smartphone shipments, they show improvement in demand thanks to the implementation of AI features. And some updates on that, we are seeing a slow and steady improvement in these two segments. The global smartphone shipments continue to improve in first quarter, as well as but the global PC shipment has only recovered slightly, just 2%. Yeah, which but still overall indicates a solid recovery trend to be played throughout the full year of 2024. We see these improvements to be driven by these new and emerging technologies such as AI as well as EV, which is expected to pave the way for the renewed semiconductor sector growth trajectory. We also find it essential to monitor the AI technology advancements and this AI global competition within the semiconductor industry, in order to keep track of this technology trends and the winners and the losers. For example, like NVIDIA and AMD in terms of this AI chip market share, as well as Micron and SK Hynix, in terms of the memory side of this AI chip. And for EV, we can also keep monitor on Tesla and BYD as well. And looking into geopolitics, we also see the Malaysian sector in line with what my colleague Cajun has presented regarding the the US-China trade diversion play, with bringing FDI inflow into the region. So likewise, we see Malaysia in a favorable position in that, when MNCs seek for alternative locations and suppliers through initiatives that you all may heard of, such as the China Plus One, and also now the Taiwan Plus One. And this is evident, as you can see, many news and announcements regarding like top tech companies, pouring investments into Penang, such as Intel. You got Micron, as well as Lam Research, Infineon as well. Pouring their investments into Penang, to grow their supply chain, to diversify away from China. So definitely with these expansion plans, we can see Malaysia's importance in the semiconductor supply chain, especially in the midst of these geopolitical tensions. Next slide, please. So we maintain our overweight call in our tech sector, as we anticipate our coverage to benefit from these inflows of FDIs by tech energy players when the tension rise between US and China, as well as the growing popularity for AI powered devices and EV as well. So definitely we advocate investors to start looking into these strong secular trends such as AI, solar, automotive, data center, medical tech, as well as 5G. Our top sector buys are currently Franken for its unique exposure in the global AI team, as well as TT Vision to capitalize on its strong demand for new solar technologies, as well as next generation vision test solutions. We also continue to like UWC for its exposure to front and back equipment makers in the semiconductor space. And if you're looking for strong exposure to EV, we see Pentamaster and Greatech as key beneficiaries for new and more advanced products that have yet to be released or are yet unveiled to the market. But however, there's also risk to be involved as they may be delayed in the semiconductor industry recovery or any order book pushback from these companies' key customers. And we also take note that the anticipated ringgit strength or may dampen the earnings because many of these tech companies actually do business in USD. Yeah, so but the global easing inflation coupled with the US Fed fund rate reductions should see investors shifting back into this growth names. Moving on to the next slide. Next slide, please. Thanks. So I'll be talking a bit of about two topics for the tech sector, which is Franken and TT Vision. So starting off with Franken. So a brief description of what Franken does is Franken provides like ultra high purity cleaning and surface treatment services required by wafer foundries in order to maintain their production yields and as well as to extend the useful life of their equipment. Just a brief explanation on whatever that means. So wafer foundries are basically the guys that create the chips, and this process is considered under the front end process of the semiconductor supply chain. Yeah, and when it comes to production use, wafer foundries will need to maintain a certain percentage of production use in order to maintain profitability or continue running their business because it's very expensive. So keeping it above a certain percentage will make sure they can run their business in the longer term. So that's why they wafer foundries will go to Franken in order to ask them to help them to clean their wafer fab equipment in order to extend the useful life for the equipment so that they won't need to replace them very often because it's always cheaper to maintain them and to buy a brand new machine. Yeah. So we see Franken is strategically positioned to benefit from this AI team and the global semicon recovery as they have a strong exposure to front-end semiconductor market and on the back of the recovery in global foundry capital spending. And we have a target price of 6 ringgit and 29 cents on this company. So we like Franken and we do advocate investors to look into Franken if they are looking for a unique proxy to the front-end semicon supply chain, as well as if they are looking for global AI team exposure. Why do we say they have an exposure to global AI team? Because Franken is able to ride on these technological advancements of these front-end customers, which some of them we believe to be TSMC as they transition into the latest nodes, such as 2 nanometers, while also benefiting from the ramp up of older and mature technologies such as 3 and 5 nanometers. And maybe a quick explanation of what these nanometers mean. Nanometer basically means the size of the chips. So basically, in order to determine whether a chip is high tech or not, one of the ways is to see that the chip is a smaller nanometer. Yeah, because a smaller nanometer will potentially mean that they are managed to squeeze in more chips into a single device, which makes the device more high tech. Yeah, because more chips means more features. Yeah. So yes, that's how we got Franken, and we also forecast a 26% CAGR throughout FY23 to 26. Maybe Kejin, you can go back to Franken as we forecast a higher contribution driven by the semicon sector as well as the wafer fab spending recovery, as well as margin expansion. Yeah. Okay, moving on to Franken. Thanks, Kejin. And as for TT Vision, they are set to benefit from the global acceleration of the solar energy adoption, as the global sentiment aims to achieve net zero carbon emissions and also the anticipated semicon sector recovery. We have a TP of 1 ringgit 50 cents for TT Vision. So what TT Vision does is they specialize in making machine vision equipment. Basically, this machine vision equipment, they actually visually inspect chips. They inspect like there's semicon technologies involved in optoelectronics, solar cells, semicons. Yeah, and they inspect it for if any cracks or any defects before it gets shipped out into the final products. Yeah, TT Vision also does some of the robotic products. Yeah. So what do we like TT Vision is because they are a direct beneficiary to not only the global solar energy adoption, but also to top tiers solar technology innovations such as a Tandem and IBC with further direct exposure to industry leaders such as Hanwha Qcell and Maxion. So if you're wondering what Tandem and IBC these names mean, basically they are different types of solar cell technologies. Currently, there are about 5 different solar cell technologies in the solar market, and Tandem and IBC are one of the top 2 most preferred cell technologies as they have the highest solar efficiency currently. So efficiency is measured by how good the solar cell transform light into electricity, and Tandem cell has about 30%, and IBC has about 25% efficiency. And Tandem and IBC has still one of the lowest adoption rates in the industry. So as the solar industry evolves and they grow and they demand more higher efficiency solar cells, Tandem cells and IBC will definitely grow as well. And since TT Vision has direct exposure to Qcell and Maxion, they can ride on this growth very well. And our findings also show that one of their major customers, Qcell, is the largest residential solar player in the US with more than 30% market share, which we find it very attractive for TT Vision to tap into. Yes. Furthermore, we also see TT Vision to be favorably positioned on the ongoing trade war between US and China. The MSC's relocation strategy, as this can be witnessed from a recent joint venture with China entity called Wuxi Outerwear. This Wuxi Outerwear is one of the top 10 global solar equipment manufacturer in the world, and they basically export solar equipment making products. Yeah. So why do we find this JV attractive? Because not only Outerwear has a substantial market share for one of its products, but also Outerwear has a really huge order book, about 8 billion ringgit, which TT Vision has the opportunity to tap into. Thus, we project a 36% CAGR over FY23 and 26 over the next 3 years, driven for this solar order book replenishment as well as semiconductor, as well as this earning contribution from Wuxi Outerwear. And that will be it from the tech sector. Right now, we can dive into Q&A.
Hold on, let me stop sharing my screen, and then maybe I'll take on some of the Q&A questions that I see in the chat box first. So okay, I see one of the question in regards to Legenda. So basically it's the reason on why there was a big gap down in the end of May for Legenda. And then so basically this is mainly due to during that time one of the senior management of the company was remanded by the Malaysian Anti-Corruption Commission, MACC, to assist in the investigation of a case involving fragmentation of about 650 hectares of Malay reserve land in Perak. And this incident, I think, was supposed to be in 2012 lah. So to basically clarify the situation, so since that day, the market reacted quite badly to the news, and then basically after the senior management was remanded for I think it was supposed to be remanded for about 5 to 6 days, but then he was released earlier, 2 days, and then right after he was released, he arranged for a meeting with us analysts and also fund managers to basically clarify on the situation slightly lah. So basically, in terms of the fragmentation of 650 hectares of Malay reserve land in Perak, we have gathered that this land in question is actually not related to the land inside of the Legenda group. And in fact, the land is the land under investigation is actually still within the senior management's private company. So it's kind of like isolated case from Legenda. And then in terms of the investigation, everything, I mean the senior management was released from the remand already, but then there's still an ongoing investigation, which is why I guess the share price is recovered a bit, but not back to the level that they were previously at, 170, 180. But then to basically reassure investors, we have gathered that that the land is not related inside of the Legenda group lah. So in terms of the operation wise of the group, the launch pipeline, everything is still intact, and then the earnings is still intact to basically achieve what we forecast for lah. And then there's a question on key housing projects launched in Johor by Legenda. So for Legenda, I believe the one that they have launched is at Mersing. The one that they have launched in the first half of this year is Mersing. The project should be called Legenda Surya. And then in second half of this year, they will be launching from one of its bigger township in Kulai. And then I believe they don't have the name for that project yet. But then basically, in terms of the projects that they have in Johor, it will be at Mersing and also at Kulai. And then okay, there's also a question on Legenda in terms of borrowing. So the question says that the Legenda has high borrowing about 800 million, and then apparently the attendees afraid that they are taking on too much risk with the borrowed money. So basically for them, I see that the borrowings of 800 over million is just about right for their size lah, given that if you look at it from the net gearing perspective, it's about 0.3 times. It's generally if for a property developer, if you have net gearing of in the range of 0.3 to 0.5 is relatively healthy lah, which in a way they can engage into borrowings to get into more land deals and secure more land bank to basically give a better pipeline of what will be coming in the future in terms of developments. So I would say borrowings perspective, I think it's just about nice at 0.3 times net gearing. And basically the net gearing increased quite significantly in the past year because they have been actively sourcing for land deals in some of the key areas in Johor and Kedah, as I mentioned, because of their ongoing multi-state expansion. And with that, as they launch all this, basically launch all this land, all this development that they plan with all this land, then they would kind of like find a balance in terms of the gearing as they sell the projects, and some of the cash gradually come in, and then as progressive billing kicks in, they construct the houses, and then the progressive billing kicks in, and they would have better cash flow in all that lah. So I would say if net gearing in the range of 0.3 to 0.5 times is quite healthy for Legenda in this size lah. Yeah.
Okay, KJ, I
Okay.
just take one other question. So one of the question is outlook on Bumi Armada with MISC put to buy. So there's this rumor going around on MISC in talks to take over Bumi Armada. This was reported by The Edge. But I think I need to clarify first. In the article, it was mentioned that it's still in early stages and have not reached any significant conclusions yet. So this isn't an already confirmed deal lah. And also that is a bit hard to determine if this is true, this talks is true or whether it's just a rumor kind of thing lah. But let's just say this deal is actually goes through and MISC takes over a substantial stake of Bumi Armada. We actually see this as a positive thing. Because Bumi Armada has been trying to secure new FPSO jobs for quite some time, but has been unable to do so. But with this MISC takeover, this could open up new opportunities for Bumi Armada, as MISC is a very reputable company, a Petronas-linked company, and has a wider global presence on it. Wider global presence. Bumi Armada actually doesn't have any FPSO operating in Malaysia, while MISC has a few operational in Peninsula and East Malaysia. And then MISC also operates in Brazil and Vietnam, so it's another job opportunity for Bumi Armada. Yep. So that's for the MISC potential takeover. The next one is there's a question on whether Dayang and Dialog is in the same market. So Dayang is more focused on the offshore topside maintenance support services, while Dialog is on the midstream. Their core business is on the midstream. So their storage tankers, those large storage tanks to store clients, so like Petronas, their oil, their reserves and all that. So it's a different business. So in terms of growth, which is a better growth buy, we think that Dayang would be a better growth buy because of their the tenders that has been going up, the upcoming contracts that has been going up, especially with the upcoming, I mentioned in my presentation earlier, the Pan Malaysia HUC and MCM contracts. Those are very big contracts, and there's 18 packages of them. So Dayang, if they were able to win about 2 or 3, that is a very good news for Dayang again. Whereas for Dialog, that for in terms of growth for them, there needs to be a new customer coming in and requesting them to build these new storage tanks for them to store their products in. So there hasn't been any news on that recently. So it's hard to say in terms of the growth there for Dialog. It's hard to see it from in that sense. So we prefer Dayang in this sense. Yeah, okay.
Okay, maybe I'll take the rest of the time with 3 tech questions. So what would be the impact on the AI companies and chip manufacturing companies if consumption from customer is less than manufacturing? So definitely if demand for AI chips is less than manufacturing, which is demand lesser than supply, definitely the impact will be not so great for the tech sector. But so far, from what I can see on the ground, which is AI technologies is still in a shortage, especially if you track over the US side. NVIDIA many people are still forecasting Nvidia to hit a record, earnings. Just one thing to note is that, people have a lot of expectations on that demand. Yeah. And there is a potential that the growth is there, but it's below expectations. Yeah. That's just one thing I want to know. All right. And regarding the question on Pentamaster, we still have a buy call on Pentamaster. It's just that it's not within our top picks currently. Yeah. Just that we replace it with a Franken and TT Vision. That's it. Yeah. And as well for the last question, Franken target price. The Franken's target price is based on 2025 year, actually, not 2024. Okay. Yeah. And I think that is all the time we have now for Q&A. Thank you everyone for tuning in and listening. Thanks.
Thanks again, Cajun, Lucas, and Sean for the presentation and interactive Q&A. We have now come to the end of the webinar today, and we would like to thank you everyone for joining. For tomorrow, Wednesday, we will be sharing the outlook and stock pick for the Thailand market. Chutikan, Head of Equity Strategy, and Adison, Assistant Vice President from PhillipCapital Thailand, would cover the Thai market outlook and top pick stocks based on outstanding investment themes. Remember to mark your calendar is on 10 July, Wednesday from 1 to 2 p.m. For the session just now, we will be uploading the recording on PhillipCapital's YouTube channel. You may view the recording of the webinar on your own time. Also, we have many other interesting webinars going on almost every other day. You may view our full list of free webinars on our website. Do take your time to fill in the survey so we can improve our work with you in the future. You may scan the QR code shown on the screen. You may also join our investing community to get free access to full research reports and discussion on technical analysis. Once again, thank you all for joining us today, and we hope to see you tomorrow. Stay tuned, take care, and have a nice afternoon.
Thank you, everyone.
Thank you everyone.
Thank you.